Here is the bottom line before we go any further. HSBC is the most talked about UK bank right now, and not because it is doing well across the board. It is dominating coverage because it is in the middle of a transformation that could either make it the dominant force in global finance for the next decade or leave it dangerously exposed at precisely the wrong moment in history. That tension is what this video is about. Let us start with what everyone already knows and then move past it quickly. HSBC has been restructuring. Georges El-Hadary, who took over as chief executive, has been aggressively reorganizing the bank around its core strength, Asia. The broad strokes of this are not a secret. Analysts have covered the Asia pivot extensively. The consensus view is that HSBC is simplifying, cutting costs, and leaning into the region where it has historically generated the most revenue. So far, so familiar. But here's where it gets interesting. Reports have emerged that HSBC is planning to cut approximately 20,000 jobs in the coming years. On the same day that news broke, HSBC's US-listed shares dropped more than 2%. Now, job cuts are normally read as a positive signal by markets: efficiency gains, cost reduction, margin expansion. So why did the stock fall? That reaction is a tell, and it's the first thing most analysts are glossing over. The market is not punishing HSBC for cutting jobs. It's asking a harder question. If you are pivoting to Asia and cutting your global headcount simultaneously, what exactly are you building? A leaner global bank or a regional bank that used to be global? Those are very different investment propositions, and right now, the answer is not clear. Now here is the reversal card, the thing most people watching HSBC coverage are completely missing. HSBC is not just restructuring internally, it is also one of the most active research engines in global finance right now. In the same week those job cut reports surfaced, HSBC upgraded ARM holdings on the back of AI server CPU growth potential, raised its conviction on Accenture as AI uncertainty reset valuations, initiated coverage on LG Electronics with a buy rating, and moved FedEx to hold. This is a bank that is simultaneously shrinking its workforce and expanding its analytical footprint across technology, logistics, and consumer electronics. Why does that matter? Because it tells you something about where HSBC sees the next cycle of growth, and it's not in traditional banking products. It's in being the financial infrastructure for the AI-driven industrial build-out, particularly across Asia and emerging markets. The job cuts are not about becoming smaller. They're about becoming differently shaped. That distinction is critical for anyone trying to value this company over a 3 to 5 year horizon. There is a second thing worth flagging that received almost no attention in mainstream coverage. The Reserve Bank of India fined HSBC for non-compliance with deposit norms. The fine itself, roughly 31 lakh rupees, is negligible relative to HSBC's balance sheet. But the regulatory friction in India is a data point worth watching. India is one of the central pillars of the Asia growth thesis. If HSBC is navigating compliance headwinds in one of its most important target markets at the same time it is cutting global staff, the execution risk on this pivot is higher than the headline restructuring narrative suggests. Now, let us zoom out and look at what the broader UK banking sector is telling us, because context here is everything.
Lloyds has dropped 12% in 3 weeks after rising 80% through 2025. Barclays is simultaneously telling investors to go overweight on UK and European equities, citing cheap valuations, accelerating earnings growth, and capital rotation out of US tech. Those two data points, Lloyds falling, Barclays bullish on the sector, seem contradictory until you understand what is actually driving the sell-off. The Bank of England held rates at 3.75% when a cut had been widely expected. Policymakers signaled that inflation control remains the priority regardless of how geopolitical events unfold. Traders are now pricing in 2 rate hikes in 2026. That is the source of the pressure on UK bank shares broadly. And here's the nuance. Higher rates are not straightforwardly good for all banks. For a retail-focused mortgage lender like Lloyds, rising rates compress affordability, slow home sales, and drive up loan impairments. Lloyds booked £1.5 billion in bad debts in 2022, the last time rates trended sharply higher. HSBC's exposure profile is fundamentally different. Its mortgage book is not concentrated in the UK housing market the way Lloyds is. Its revenue base is geographically diversified in a way that gives it more insulation from a UK-specific rate shock. That does not make HSBC immune to the macro environment, far from it. But it does mean the current sector-wide sell-off may be creating an asymmetric situation between HSBC and its domestic UK peers. So where does this leave us? Let us run the 2 primary scenarios. If the Asia pivot executes cleanly, if El Hadary successfully reshapes HSBC into a leaner, technology-oriented institution with deep roots in Asian capital markets, and if the macro environment in the region remains constructive, then the job cuts start to look like the right kind of pain taken early. Capital return updates become the story. Institutional investors who stayed through the restructuring get rewarded. The analyst community, which has HSBC leading UK bank coverage at 85 mentions, shifts from monitoring execution risk to pricing in the upside of a completed transformation. That is a very different stock than the one trading today. But if the pivot stalls, if regulatory friction in India and other Asian markets slows revenue ramp, if the geopolitical environment between the US and China deteriorates in ways that complicate HSBC's positioning as a bridge institution, if the job cuts hollow out institutional knowledge faster than the bank can rebuild around its new priorities, then the 20,000 job reduction starts to look less like strategic efficiency and more like a bank that overcommitted to a thesis it cannot fully execute. In that scenario, the stock faces a prolonged re-rating period, and the domestic UK peers that were already under pressure provide no sector-level support. The recovery path in the downside scenario is not zero. HSBC's capital position gives it room to maneuver. Its research and advisory capabilities, as evidenced by the volume and range of its recent analyst activity, remain a genuine competitive asset. And Barclays' broader argument about UK equity valuations being cheap relative to US equivalents applies to HSBC as much as anyone. The floor is not as far down as the current sentiment might suggest. What this moment actually represents is a stress test of whether HSBC's restructuring was a genuine strategic repositioning or a cost-cutting exercise dressed up in strategic language. The next few quarters of execution data will answer that question more definitively than any analyst note. Watch the Asia revenue line, watch the capital return cadence, and watch whether the job cuts slow down or accelerate, because the direction of that number will tell you more about management's real confidence level than any earnings call talking point ever will.